Welcome back, everyone. The 4-factor stock selection strategy is doing great. February was another great month to get on the books, with the strategy delivering another win over the S&P 500 and SCHD. But before I get to the performance update, let me just briefly talk about what this strategy really is. The 4-factor dividend growth strategy is my attempt to build a simple dividend growth portfolio that can deliver strong returns, all the while building a growing passive income stream. The keyword here is simple. This means that there aren't many moving pieces, and that this strategy doesn't require me to make a lot of decisions or take a lot of actions to keep it running. All I need to do is run the stock selection process once per year, find the best stocks and hold them for a full year. Then next year, I just repeat the same process all over again. Throughout the year, I just sit back, relax, and watch the strategy work its magic. Nice and easy. Just because a given strategy has worked out in the past, doesn't mean it will continue to work in the future. Very true. Which is why I am testing this strategy in real time to see exactly if it works well or if it doesn't. With that said, let's take a look at how the strategy has worked out thus far. February was the 16th month on the books, so I've been at it for a full year and 4 months into the second year now. The strategy was launched on November 1st, 2022. Year 1 was decent. The portfolio delivered a total return of 10.9%. This was below my long-term target of a 12% CAGR, but slightly ahead of the S&P 500 and SCHD. But the keyword here is long-term. The 12% CAGR target is where I would like the strategy to be in 5 or 10 years in the future. Whether we get there or not, time will tell. Year number 2 is off to a great start. In February, the portfolio posted a solid gain of 6.99%, relative to 5.34% for the S&P 500 and 1.84% for SCHD, a nice little win for my strategy. The 4-month return since November 1st, 2023, when this portfolio was rebalanced for its second year, currently stands at a whopping 27.92%. Pretty fantastic, but without context, this return is a bit meaningless. So let's see how well the portfolio stacks up against the S&P 500 and SCHD. The 4-month return for the S&P 500 stands at 22.2% and 15.25% for SCHD. So my portfolio, in its second year, is currently 5.71% ahead of the S&P 500 and 12.67% ahead of SCHD. Combining year 1 and partial year 2, we get a cumulative return of 41.86%, or a 29.98% CAGR. So the portfolio is back on track and currently has built up a pretty nice cushion, placing it well above its long-term 12% CAGR target. Comparing the CAGR to the S&P 500, my portfolio is beating the benchmark by 5.02%, and it's beating SCHD by 22.54%. Where do we go from here? Who knows? Time will tell. But I believe this strategy is built on a sound process of finding high-quality dividend growth stocks, and for that reason, I believe it'll continue to work well going forward. Probably not all of the time, but when viewed over the long term, I expect this strategy to meet or exceed my 12% target CAGR, and remain competitive against the S&P 500 and SCHD. If you want to know the details of how this strategy works, you can check out some of the older episodes from this series. I think repeating the step-by-step process in every episode can get pretty annoying, especially for those of you that have followed the strategy from the beginning. Alright, let's talk about the actual portfolio, the individual stocks, the dividends, and the observations I've made thus far. The average return for all 25 stocks in this portfolio in February was 7.12%. This is the perfect equal weight return. My portfolio return was slightly worse because it's very difficult to rebalance the portfolio every month. 8 out of the 25 stocks rocked a cool double-digit gain in February. The best stock was Williams-Sonoma with a gain of 21.79%. Number 2 was Monolithic Power Systems with a gain of 19.47%. Number 3 was SQM with a gain of 18.18%. Number 4 was Masco with a gain of 14.52%. Number 5 was Lam Research with a gain of 13.7%. Number 6 was Old Dominion with a gain of 13.16%. Number 7 was Lowe's with a gain of 13.08%. And number 8 was Broadcom with a gain of 10.21%. 15 out of the remaining 17 stocks posted positive gains, and only 2 stocks finished the month in the red. Let me run through them all quickly. ASML up 9.6%, Home Depot up 7.83%, Fastnell up 7.01%, MasterCard up 5.68%, UPS up 5.63%, Texas Instruments up 4.5%, Cohen and Steers up 4.44%, ADP up 2.18%, Rollins up 2.13%, Robert Half up 1.76%, Paychex up 1.47%, Skyworks up 1.1%, Watsco up 0.8%, EOG Resources up 0.59%, Infosys up 0.5%, Landstar down 0.62%, and Microchip Technologies down 0.69%. Overall, a very solid month and a solid start for year number 2. Thus far, in year number 2, 24 out of the 25 stocks in this portfolio have a positive return. The only bad apple is EOG Resources, that is still down 7.47%. 21 out of the 25 stocks have double-digit returns, and 5 stocks are up more than 50% in the last 4 months. I'm always tracking the individual returns of all the stocks and paying attention to any patterns that can help me refine this process and make it more efficient going forward. Something I pay very close attention to is how well the stocks are performing, based on how they ranked in the original stock selection process. In February, the top 5 ranked stocks performed the best, rocking a cool 9.95% return. The second best group were stocks 11 through 15, with an average gain of 9.53%. And the worst performing stocks were those ranked 16 through 20, with a gain of just 3.17%. However, over the last 4 months, the best performing stocks are those ranked 6 through 10, with an average gain of 37.67%. Stocks ranked 11 through 15 and 16 through 20 are pretty close, with gains of 29.91% and 30.3%, respectively. The worst performing stocks are the 5 highest ranked stocks and the 5 lowest ranked stocks, with gains of 19.91% and 19.31%, respectively. In year number 1, the highest ranked stocks also did not perform too well. Something I considered for year 2 was whether I should select the top 20 or 25 stocks. Ultimately, I chose to go with 25 stocks, but thus far it looks like going with just the top 20 stocks would have worked out slightly better. The equal weight return for all 25 stocks for the last 4 months is 27.46%, while the top 20 stocks have a return of 29.55%. So a little more than 2% in additional return thus far. Another aspect I am testing is whether rebalancing the portfolio each month to bring the weight of each stock back to 4% is working out better compared to doing nothing and letting the stocks just compound on themselves for the entire year. Thus far, the not rebalanced portfolio would have led to a better return, 27.66% versus 27.46%. Not a big difference, but nonetheless it is a higher return, and also would not require me to rebalance the portfolio each month. I hold my portfolio in a tax-deferred account, so there is no tax liability from rebalancing frequently. If I held this portfolio in a taxable account, I would not be rebalancing every month, which would definitely create some tax drag. We are still early into year 2, but I am leaning towards making a few changes for year number 3. The first would be to trim the number of chosen stocks from 25 down to just the top 20. And the second change would be to get rid of the monthly rebalancing to further simplify this strategy. Alright, let's talk dividends, since this is a dividend growth strategy after all. February dividend income came in pretty mediocre, with just $3.24. This was nearly 11% lower compared to February of 2023. The portfolio is a little cyclical and spits out more dividend income during quarter-ending months. Since inception, the forward annual dividend income has grown by 25.48%, which is pretty solid. And thus far, year 2 dividend income is coming in about 65% higher than year 1 dividend income. I expect this to trend down a little bit throughout the remainder of the year, but it will be interesting to see where the portfolio finishes come October. This portfolio is quite small, currently valued around $2,600, but I have not added any new money to this account since the 4-factor strategy was launched, mainly to make it easier to track the return and dividend growth. I've invested more capital in other accounts into the 4-factor strategy, but to not complicate things, I am strictly sharing just this portfolio. In addition to tracking this portfolio, I am also tracking how well the 4-factor strategy chosen each month is performing. I started my portfolio in November, so I'm on the November to October cycle, but I was curious how well this process would work out if I started any other month. I've been tracking the 4-factor list since June of 2023, which gives me 10 unique lists. Out of these 10, 9 are currently performing better than the S&P 500, and all 10 are beating the SCHD. I share this data on my Patreon if any of you are interested, and the new 4-factor list is published at the end of each month. I don't encourage anyone to use this strategy. You need to decide for yourself if it's something that makes sense to you, and if you're willing to accept the risk. I hope you enjoy the content. If you did, please do me a favor and give this video a like and subscribe to the channel. Thank you for watching and see you next time.